You're entering the future-ready CNBC TV 18 EBIX Cash Studio.
Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Passive funds. Yes, you've been hearing this term for a long, long time, and there's a huge debate out there about how you need to start looking at passives as a way of investing, as a way of adding some variety perhaps towards your mutual fund portfolio. Well, we will, of course, get you the basics of passive investing, but today the show is a little more evolved as well. There are several strategies that passive funds sort of adopt the world over, and some of these strategies have made their way in India as well. There are smart beta funds. There are funds which are based on factor-based investing. So don't get perturbed by some of these technical terms, because we will make it very simple and easy for you to understand right here on Money, Money, Money. And then ask the basic question, should you bother with some of these strategies at all? Well, joining in to demystify all of this for us today are Anil Ghelani. Anil is from DSP Mutual Fund, and he looks at the passives business over there. And we also have Kalpesh Ashar of Full Circle Financial Planners and Advisors joining us on the show. Thank you very much, gentlemen, for taking out the time and for being with us. So, you know, I think, let's face it, I don't think it's a debate anymore. There is an element of passive investing that all of us need in our portfolios because it is so cost effective. But how should you even look at it or approach it? So first, quick thoughts before we get into the classroom. Kalpesh?
Yeah, actually, Surabhi, the passive mode of investment has caught up of late. So if you just dig deep, probably 5 to 10 years back, not many people were inclined for the passive mode of investment. And of late, it has been seen that people have realized that I would attribute it to low cost investing and an easy avenue of investments. So that takes the real headache out of the real research part of it, and people get straight to the point, I think, as you say, in investing. So it's caught up, and more so it's caught up in the last couple of years, I think, and it's caught up a lot. But we need to still analyze whether what is good for a portfolio between active and passive.
Absolutely, and we are going to raise that very important question as we go along the show. Let me welcome in Anil as well. Anil, thanks for joining in. I remember you did one of the passive investing classrooms with us on Money Money way back 3-4 years back, and we've come a long way since then, right? Now, passive investing, for those who are still not familiar with this, is all about following an index. There's no human fund manager. The fund simply mirrors an underlying index. So Anil, you tell us, what has the customer experience, the investor experience been, and where do we really stand now in India with respect to the passive journey?
Sure. First of all, great backdrop, Surabhi, and I think it's always very interesting the way in which you connect the markets with what the investor can actually use in his or her own portfolio. So you are absolutely right that passive investing has taken off in quite a big way over these last 3 odd years. I feel personally that as we move ahead, passive funds will become a very important complementary allocation in any investor's portfolio. So let's say if today one has to build a portfolio where there is a long-term wealth creation being done, some core allocation of one's portfolio will very easily be allocated towards the low-cost ETFs or index funds, and the satellite or the other allocations will be going towards the active funds. So absolutely right what you mentioned. There is no longer a debate of active or passive. It's very clearly active and passive. People will need to use passive funds as a complementary rather than a competing strategy, to think about it in that way. And just to conclude it, how you mentioned that what's happening globally, Surabhi, we are already seeing in many markets, the tide has turned where net new flows is much more larger in passive funds as compared to active funds, especially let's say in US or some of the other developed markets. Personally, I feel there is still a little bit time to see the reversal of the tide, but yes, definitely even in India, we have started seeing a very healthy adoption of passive funds like both index funds and ETFs, and we have started seeing an increased participation by retail and HNI investors as well. Whereas though earlier it was driven by corporates and institutional demand, now a large number of retail investors have also started adopting passive funds as a complementary strategy into their portfolio.
Okay, well, yes, I guess it's showing up in the numbers. Every time we look at the AMFI data and the ETF category, those numbers have been swelling. So, okay, let's get the classroom started now because we, as I mentioned, we are going beyond Nifty 50 or Sensex 30 based funds. So, Anil, tell us that beyond these absolute plain vanilla formats of passive investing, what are some of the other type of passive funds that now we are beginning to see in the market?
See, whenever we look at, let's say, Sensex or Nifty or what we call as the market cap weighted funds, or what we call as buying the market, or what in slightly complex term we call as, okay, we are investing in the beta of the market, right? And anything that uses a weightage categorization other than the beta is what we call a smart beta. So simply put, in any portfolio or any index where there is a weightage criteria which is based on some predefined rules or certain different aspect of how the stocks and sectors can be selected, is what we call as smart beta. So what happens is that certain rules, or let's say a formula, is created and then it is followed without any human bias so as to achieve the similar type of a benefit, that there is no human bias, there will be transparency, there will be convenience and cost savings, but with the endeavor to achieve one or more of three key criteria. You know, whenever one is making investment, you either want a return enhancement or you want a risk reduction.
Yeah.
So by adopting some such formula or rule-based approach or going the smart beta way, you're trying to deliver either excess return or a reduced risk on top of the plain vanilla beta or the market. So in India also, like global markets, now we have got, broadly speaking, you can bucket these into four segments. The first should be can be something what we call strategy-based funds. You know, so let's say, for example, one can have a equal weight as a strategy. It's like a simplest form of smart beta. You know, where rather than figuring out which particular factor or which particular segment of the market will do well, you equal weight it.
Yeah.
Then there would be sector-based. So there can be like, IT, pharma, consumer sectors. Of course, banking sector is always there since quite some time, and there are also derivative contracts very actively traded on that. So even over here, one can think of these sector-based as the second core aspect of the smart beta category or different aspect. The third would be what we can think of as a theme-based. So in theme, rather than one particular sector, there will be a broader theme. I'll take one basic example, which many of us as investors or all of you might be aware or have been trying to follow is, let's say, for example, ESG. So let's say ESG can be a theme which can encompass multiple sectors. So you could have a ESG index or a ESG ETF, which will have multiple 4, 5, 6 sectors, but all stocks within that particular index or that portfolio will be selected using the ESG as a theme.
Right.
And then the last or the fourth bucket would be what we call as the factor-based. So in factor-based, you can have, let's say, things like momentum, low volatility, quality. Quality becomes very important, especially in markets like ours, and when you're going down the market cap space, let's say when you mid cap. So, this is the other aspect where, let's say, mid cap quality or large cap momentum. So broadly in these four buckets, one can identify and put the funds.
Okay, got that. So 4 types of funds. You've been seeing, of course, some of the graphics on the screen as well. Strategy based, as Anil just described to us. Sector based is pretty self-explanatory. Sectors can be banking, FMCG, pharma, and some of these indices already exist, either NSE indices or BSE indices, and there could be a fund that replicates that particular sector. Theme, ESG is one theme, perhaps electric vehicles could be another theme, and it depends on the indices that come up on these individual themes. Now, factors, and Anil, here is where I want to sort of get your view in some more detail. The concept of factors. and how you describe then smart beta. Now, I could sort of see it as a trait. You could take a set of stocks which follow a certain trait, let's say quality, certain stocks in the market that are defined by quality, or perhaps low volatility. So then how are funds created using these factors? Are they only based on one factor? We also hear of multi-factor indices. So in India, which are the sort of indices or which are the funds which are already going the multi-factor way?
Very good point. And so I'll take like maybe about 30 seconds, slightly digress and give the simple rationale and one can relate to it very easily. What first of all we mean by factors. So I will give it with an example which is very topical for today. Let's say we are in the middle of November. Many of us in different cities, wherever we are, many of us are planning for the marathon. Right. So in that, our dietitian has said that, okay, you need certain component of proteins, minerals, carbohydrates, and then all the food and beverages that we intake, you keep dissecting through that and trying to see that how much carbohydrates or how much proteins I finished and how much is a pending. So very similar to that, when we come to investing, each of the security or each of the stocks that we look at can be sliced and diced by the risk and return components of that particular investment security. And those are nothing but what we call as factors. So it can be value, momentum, volatility, size. Now with that logic and as the underlying, you can think of when we talk about, let's say, factor-based funds or factor-based ETFs. So let's say there would be one particular factor, let's say quality, as you picked up as an example. So each of the particular quality factors from each of the stock that has been dissected will be bucketed together and a particular index will be created with that particular one factor, let's say quality as a factor. Or let's say you think of momentum. Friends, momentum, if you look at history over the past long term in India, or many of the developing markets, momentum as a factor most of the times has done extremely well, except for certain inflection points when there is a change in the market trends. So let's say you build a momentum portfolio. So all the securities which are high in momentum will be bucketed together and a particular index can be created on which the fund can be operating.
Yeah, got that point. Anil, actually, you know what? I was a little curious. So I looked at some of the indices on some of these so-called factors. Let's pull up those graphics. So NSE, for instance, and this for our viewers, and NSE already has a Nifty 50 Value 20 index. And there are funds already available on this index. It's called the NV20 index. So the index constituents are on your screen. These are supposed to be, according to the formula, 20 of the value stocks within the Nifty 50, Bajaj Auto, Grasim, Coal India, quite a long list out there, 20 stocks really. Similarly, there is a Nifty 100 low volatility 30 index. So basically 30 stocks from within the Nifty 100 which are supposed to be low volatility stocks, and the constituents are on your screen. So these are indices created by the stock exchanges, and then asset managers go ahead and create passive products on them. So this is all about the academic part of it. Now we come to the practical. The theory is over. And the practical is, should you put your money in these funds? Do they make sense? That question answered with both our experts after a very, very short break. Welcome back. Here with us on Money, Money, Money. And this week we are breaking down the pros and cons of slightly more evolved passive funds that work on smart beta or multi-factor strategies. Anil, Ghelani of DSP Mutual Fund as well as Kalpesh, Ashar of Full Circle Financial Planners and Advisors are with us. So we've done the theory part. Now it is time to look at the practical. How do we really apply this and select the right funds? So Kalpesh, I'll throw this open to you. What has your experience been, and how do you go about advising someone to build their portfolio, incorporating some passives into it? Kalpesh? Okay, I don't think the line is through to Kalpesh. Kalpesh, if you can hear me, I was asking you for your recipe, how to blend in passives with the portfolio. Okay, I think there's some issue with the line. We'll get that fixed. Anil, you tell us, we already have some funds in this category, but what's the track record? And, in terms of performance, at the end of the day, it's about risk return. In terms of performance, do they really make the cut for investors?
Oh, yes, absolutely right. See, in many time periods, there are certain smart beta funds which have done extremely well. Or even if you look at plain vanilla, like the beta funds, or like, let's say, if you just look at Nifty 50, and if you look at the past couple of years data and compare it with, let's say, actively managed large cap funds, across many time periods, Surabhi, the Nifty 50 has done, like, in fact, much better than many of the actively managed large cap funds. Or let's say little bit differentiated strategy type. If you look at certain indices like Nifty 50 equal weight index, in this last about 2 years, it has done much more better than even the Nifty 50. So this type of smart beta strategies and ETFs can definitely act as a good way of increasing returns profile of the investor's overall portfolio, as well as in certain cases looking to reduce the risk profile. So yeah, definitely, if we look at the past data, it has been quite useful to own as a part of the overall portfolio.
If I were to play sort of, devil's advocate, it's also perhaps true, Anil, that there is so much product innovation that's going on. And a lot of launches are actually coming in on the passive side. So it's very easy for an investor to get confused and lost. So let's say if you were to create a portfolio that has the right blend of passive funds, plain vanilla Nifty or Sensex, and slightly more evolved strategy-based funds, what would that perfect bouquet look like?
Very good idea. Very good point. Of course, it's in many ways very difficult to give a judgment for some other investor, because everybody will have their own risk and return objectives and risk taking appetite, and for that it's always best to consult your trusted advisor. But Surabhi, I will little bit twist it that I'll just describe how it would, if suppose it would be my portfolio, and if I want to invest, let's say for example, into let's say from 100 rupees, 60 rupees is my equity, 40 is debt. So that's 60 rupees how I would invest, right? So I would have, let's say for example, the plain vanilla beta or the passive core allocation of about 15 rupees. My smart beta could be slightly lesser at 10 rupees, right? So that completes like about 25 rupees out of my 60 in these passive funds. Then I will come to active, which will be another 25 rupees. So no doubt active also, I'm saying 50-50 allocation, which will be typically into like some specialized thematic portfolios, some small cap allocation that can be taken definitely through active.
Yeah.
And then the balance about 10 rupees would be into so-called, little bit, let's say global funds, international exposure, sector funds, like that way,
Okay, Anil, got that point. We unfortunately had a bit of a tech trouble, so our advisor is joining us really late, but, we'll have the final word from him. So, Kalpesh, we've understood a theory. There are lots of new products being launched on the passive side in the market, but you tell us what's the healthy mix to ensure that the cost of the portfolio remains low and one gets the advantage of better returns?
Yeah, so what I would suggest here is that, passive funds, like we mentioned, that they have their own advantages. But simply because they mirror the index and are low cost, it should not make them an automatic choice in a portfolio. And as we talk about personal financial planning, it all depends on the investor's profile. So we've seen by track record that index funds have an edge over active large cap funds to an extent. So if I were to create a portfolio, I would ideally in the large cap space, give a 50-50 allocation just to weigh the performance of how a passive fund is performing against an active large cap fund. Otherwise, when it comes down to the mid and small cap category, I would surely go in for an actively managed mutual fund, thereby giving the advantage and the cost to a certain extent to the fund manager to prove his expertise and generate that alpha for my portfolio there. So I'm only talking about the equity component out here. Secondly, the sectoral part or the thematic part, I think of late that is more of the garnishing which has happened in the passive fund space. I would like to keep it plain vanilla when it comes to passive. If it's a simple product, so be it. Let it remain simple. So even if my strategy of choices in suggesting some passive funds would just be limited to the Nifty index, I like particularly the Nifty Next 50 space because that's a lot of dynamism going on there, and a normal investor would reap the benefits in the Nifty Next 50 or something in an international fund space. Even the Nasdaq 100 index fund, which is just recently open for subscription now, and it just is open again. So that would be a real, pure vanilla mix in the passive fund. So I would not like to, clutter it with too many thematic things, because as it is in the active space, we are doing that. And more so in the active space, we have the advantage of a flexi cap, portfolio there.
Okay.
So to sum it up, that if you're looking for an alpha in your portfolio, still active funds would do the job, and a prudent mix of active and passive, I think, is necessary for a good long-term portfolio.
I guess the message is that it's not either or. It's about the right blend and the right mix depending on your investment goals and your risk appetite. Well, with that, we're completely out of time. Thank you very much, gentlemen, for joining in on this passive investing classroom. We'll, of course, keep bringing you more themes and ideas next week. Thank you for watching.